How's it going all? Welcome back to the channel. So in this video, we're going to talk about how you can earn up to 4.8% interest on your money. Additionally, we'll answer the very important question of which is better, callable or non-callable CDs. Either way, your money is still FDIC insured and you'll be getting way better rates than with a traditional high yield savings account or a regular CD. So without further ado, let's get started. As you may know, a bank CD is a type of savings account where you lock up your money for a given duration, often between 6 months and 5 years. Now, because you agree to give your money over to a bank for a long duration, they generally pay you a higher interest rate. For example, Ally Bank is happy to pay you 3% APY on a regular high yield savings account. But if you want to lock up your money for 12 months, Ally will pay you a solid 4% instead. So if you tend to hold a lot of cash, this extra 1% could mean several hundreds to even thousands of dollars of additional interest. That said, brokered CDs can be a much better option. These are CDs issued by banks like Ally that are traded on the secondary market. Popular brokerage firms like Fidelity and Charles Schwab can offer you CDs from hundreds of different banks across the country. And because brokered CDs are still debt obligations by the issuing banks, the money that you deposit is still FDIC insured. And one of the nice things about brokered CDs is that they work the exact same way as bank CDs. If you hold it until maturity date, you will be paid back all of your money plus interest. Now, because brokered CDs are tradable on the secondary market, you can also sell your CD before it matures. The value of your brokered CD will fluctuate though depending on many factors, including the size of your deposit, the interest rate environment, and the time until maturity date. The market is not as liquid as trading treasuries, but it's still fairly liquid and can offer more flexibility than bank CDs. That said, some brokers may charge small fees if you sell a CD before maturity date though, so it's worth checking in with your broker first and planning out your savings so that you're not in that type of situation to begin with. Another nice thing about brokered CDs is that you can also expand your FDIC coverage beyond the traditional $250,000 limit. You can actually combine a number of CDs issued by different banks through the same brokerage account. For example, I could put $250,000 into brokered CDs each at JP Morgan Chase and Capital One. I'd still end up with $500,000 of FDIC coverage even though I'm managing all of my money on Fidelity. Not only do I still get my FDIC coverage, but I can manage all of my savings through just a single platform. Of course, if you don't want to manage CDs by yourself, you can always let a broker do it for you. Many brokerages like Charles Schwab or Fidelity actually offer automated CD ladders that help you earn some of the highest interest rates possible, while still allowing your money to be easily accessible. So if you need cash, you can always pull some money out every few months. Now, if you don't need to, you can always let Fidelity reinvest it for you and earn some high interest rates. But at the end of the day, the primary reason why people choose brokered CDs over bank CDs is simply the higher interest rates. For example, Ally Bank was offering 4% on a 1-year CD. That's not bad. However, if I pull up Fidelity instead, I have a decent selection of FDIC insured banks offering up to 4.75% interest for the same duration, and that's 75 basis points higher. And to put that in perspective, these brokered CDs are offering about $75 more of interest per $10,000 that you deposit. And for most people, that's a very good improvement. And overall, you can earn much more interest with brokered CDs compared to bank CDs. And a common question that I get asked is, why do brokered CDs offer way better value than bank CDs? And the answer is that brokered products are in a much more competitive market. A broker like Fidelity can transact large volumes of capital and deposits, allowing them to negotiate better rates with banks for their customers like us. For example, let's say that Ally Bank is offering 4.25% APY for Fidelity customers. Later on, Capital One comes in, sees there's a lot of money on the table, and offers 4.75% interest instead. That's 50 basis points more. Now, from the investor side, the bank name doesn't really matter. Both are FDIC insured, and you can deposit money in either one and manage all of your savings under Fidelity anyways. So from the investor's side, most people are probably going to deposit money into Capital One. As a result, Ally Bank must respond quickly and offer better rates. Soon, they might even offer the same 4.75% so that they compete for some of the resources from Fidelity clients. Otherwise, Ally Bank doesn't receive a lot of deposits and they can't give out loans as easily and earn that sweet interest income. On the other hand, bank CD rates are fully at the discretion of the issuing bank. For you to move your money from Ally Bank to Marcus by Goldman Sachs in order to get better CD rates, you would still need to open a new account and transfer your money. Some people, understandably, don't want to go through that hassle. Ally Bank knows this, so they'll offer you the lowest rate possible at just 4%, so you're still happy to keep your money, but they can save as much money as possible. Now, when you shop for brokered CDs, you may notice a column indicating whether a CD has call risk. Most bonds are non-callable. You deposit money into the CD and you are paid a fixed interest rate for the entire duration. However, a callable CD is one where the bank has the right to liquidate your bond before maturity date. This makes the CD more risky than non-callable ones. And to compensate for the higher risk, these brokered products tend to pay higher interest rates. For example, Medallion Bank is offering 4.5% APY for a 2-year non-callable CD. Very good rates, and I can hold onto this CD until it matures next year. However, if we look above, New Millennium Bank is offering 4.8% APY for a 2-year callable CD, which is 30 basis points higher. Even better rates. The only downside is that they have a call schedule. Every month, starting June of 2023, the bank is going to look at the rates and see if they are still happy paying you that 4.8% APY. And let's say, for example, that interest rates rise to 6%. This bank is probably happy to continue paying you 4.8%. So they're not going to call away your CD, and you are good to continue earning that higher interest rate for as long as rates remain high. But let's say that we enter a recession and the government wants to lower rates in order to stimulate the economy. Totally possible given today's interest rate environment. And suppose that interest rates fall to, say, 3%. All of a sudden, the bank's not happy. They don't want to continue paying you 4.8% APY when other people are happy to receive 3% instead. So they might call away your CD. Rest assured, you will still be paid back all of your principal plus any accrued interest. However, you won't be earning 4.8% anymore, and the next best investment options might be offering lower yields at just 3%. So at the end of the day, you are taking on more risk when you buy callable CDs. And the main question is whether you believe interest rates will rise, remain the same, or fall in the future. Additionally, are the rates of callable CDs high enough to compensate for the additional call risk? And that's a question that will vary depending on the person. And for me personally, and for most investors, we prefer non-callable CDs. And that's because we like having guaranteed income because it helps us better plan out our savings. Yes, the rates are a little bit lower, but I personally do like having some of that downside protection in case interest rates fall in the near future. That said, my threshold to switch to callable CDs is about 50 basis points. So for example, if non-callable CDs are offering 4.5% right now, I would only consider callable ones if they offer at least 5%, which right now is not the case. Now, again, that's my personal threshold, and I would love to know your thoughts and your own thresholds for when you might consider callable CDs. But if there's one thing that you take away from this video, it's to always shop around for the best rates. And throughout this video, I've only focused on rates offered on the Fidelity platform. For example, the best 2-year CD on Fidelity was a callable one offered by New Millennium Bank at 4.8% APY. However, if you went to Charles Schwab, you could have found a 2-year non-callable CD offered from another FDIC insured bank, giving 4.7% APY. The bank can't liquidate your CD early, and you can practically get the same exact high interest rate at Charles Schwab. So at the end of the day, it's always best to shop around. Every brokerage platform offers CDs from different banks, and some brokers might offer some better value. And because it's a holiday season, I figured I should end it on a high note. For example, you can get an additional $101 for free when you open up a Charles Schwab account with the Schwab Starter Kit. You have to deposit $50 within 30 days of account opening, but that's a guaranteed 200% return for 10 minutes of your time. Additionally, Schwab is a full service platform, so you can buy stocks, options, and fixed income assets like the brokerage CDs that I mentioned here on this video. As always, if you enjoyed this type of content, please feel free to leave a like and subscribe for more. Stay tuned for more. Have a great one. Have a great holiday season. Take care.